The number one question I get every single day right now is this: why isn't XRP moving? And I want to answer that question directly because the answer is not what you think. And it is not what anyone on crypto Twitter is telling you. While the crowd is staring at the daily candle, refreshing price alerts, waiting for a catalyst they can see, the actual catalyst is happening in a place most retail investors never look. It happened inside a regulatory filing. It happened inside a prime brokerage deal worth $125 billion. And it happened inside a framework that was quietly written into federal law. The move is not coming. The move has already started. And today I'm going to show you the receipts. Welcome back to Ledger.Wealth.Network. Before we go under the surface, this is not financial advice. Everything you're about to hear comes from publicly available filings, on-chain data, and institutional research. My job is not to tell you what to do with your money. My job is to make sure you are looking at the right information. Let's get into it. Let me start with something that most people in this space have completely misread. On March 19th, 2025, Ripple announced the acquisition of Hidden Road, a prime brokerage that clears over $3 trillion in transactions annually across 300 institutional clients. The crypto press covered it as a business story, a corporate deal, an expansion play. They missed the entire point. Here's what Hidden Road actually is, and why this acquisition is one of the most significant events in XRP's history. Prime brokers are the infrastructure layer of institutional finance. They are the entities that sit between hedge funds, asset managers, and sovereign wealth vehicles on one side and the actual markets on the other. They handle the clearing, the collateral management, the credit lines, the settlement. They are the plumbing that institutional capital flows through. When Ripple acquired Hidden Road, they did not buy a crypto company. They bought a seat at the table of institutional capital infrastructure, and they announced immediately that Hidden Road's post-trade infrastructure will be powered by the XRP ledger. Think about what that means in practice. Every one of Hidden Road's 300 institutional clients, hedge funds, asset managers, market makers will now have their post-trade settlement running on XRP ledger rails. They are not buying XRP voluntarily. They are not speculating. They are using XRP ledger as the infrastructure beneath transactions they are already making. This is not adoption through marketing. This is adoption through integration. And those are two completely different things. Voluntary adoption requires someone to choose XRP. Infrastructure integration requires XRP to be present whether the end user thinks about it or not. That is the model that built Swift. That is the model that built Visa's settlement rails. And that is the model that Ripple just installed into a $3 trillion annual transaction flow. Retail investors looked at this acquisition and thought, interesting business news. Institutional analysts looked at this acquisition and thought, Ripple just became a prime broker. The correct interpretation is both of those things simultaneously, and the implications for XRP's role in institutional settlement are only beginning to surface in the data. Let me give you the math that the crowd is ignoring. The global prime brokerage industry processes approximately $12 trillion in annual transaction volume across all asset classes. Hidden Road clears $3 trillion of that, roughly 25% of total prime brokerage throughput. When XRP Ledger becomes the post-trade settlement layer for Hidden Road's transaction flow, it immediately becomes one of the most utilized blockchain settlement networks in institutional finance, not by speculation, by contract. Now here's where the supply math becomes impossible to ignore. XRP has a fixed total supply of 100 billion tokens. Circulating supply sits at approximately 57 billion. Exchange reserves tracked by CryptoQuant are sitting at multi-year lows. The liquid float, the tokens actually available at current prices for institutional purchase without moving the market, is a small fraction of that circulating number. Here is the math that matters. The global cross-border payment market moves $150 trillion annually. Swift, the current rails for that volume, was built in 1973. It operates on a correspondent banking model that requires pre-funded accounts, called Nostro and Vostro accounts, to sit idle at counterparty banks around the world. The capital locked in those Nostro Vostro accounts is estimated at $27 trillion, not working capital, not deployed capital, stranded capital, sitting in accounts to grease a 50-year-old payment system. Ripple's technology eliminates the need for those pre-funded accounts. It replaces idle collateral with real-time settlement. If RippleNet and the XRP ledger displace even 5% of that $27 trillion in stranded capital by providing a real-time settlement alternative, the utility demand for XRP as a bridge asset in those transactions is measured in hundreds of billions of dollars flowing through a token supply that cannot expand. This isn't a Moonboy fantasy, it is a design requirement. For XRP to function as the bridge currency in transactions that are already contractually flowing through Hidden Road's infrastructure, the price of XRP must be high enough to provide sufficient liquidity for the transaction sizes involved. That is not a prediction. That is a functional specification of the system that Ripple just acquired the right to build. The math is not complicated. Fixed supply, contractually integrated transaction flow, institutional demand entering through infrastructure channels that bypass the retail market entirely. The price does not need permission to move. It needs sufficient demand relative to available supply, and that demand is now contractually guaranteed. While retail is watching price, ask yourself what the institutional signal is actually saying. Franklin Templeton, a $1.6 trillion asset manager, now has XRP integrated into its blockchain research framework. Their analysts have specifically cited the Hidden Road acquisition as evidence that Ripple is building institutional rails, not retail speculation infrastructure. That framing matters. When a $1.6 trillion firm categorizes your asset as institutional infrastructure rather than speculative cryptocurrency, the compliance pathway for allocation opens in an entirely different way. Standard Chartered's digital asset desk, not a crypto-native shop, a 160-year-old global bank, has maintained a $5.50 near-term price target for XRP with a $12.50 target for the end of the cycle. Their analysts are not basing that on retail momentum. They are basing it on the utility model, on the prime brokerage integration, on the ODL volume data that shows on-demand liquidity corridors expanding in Southeast Asia, Latin America, and the Middle East. And then there is the tokenization angle that almost nobody is connecting to XRP yet. BlackRock's Buidl Fund, the largest tokenized money market fund on-chain, currently operates primarily on Ethereum. But the multi-chain expansion of tokenized real-world assets is not a question of if. It is a question of settlement efficiency. And the XRP ledger's settlement finality, 3 to 5 seconds fractions of a cent in fees, is not comparable to Ethereum's settlement environment for institutional scale transactions. When tokenized RWA volume crosses $4 trillion, which multiple institutional forecasts project within this cycle, the settlement layer question becomes a competitive infrastructure question. And XRP ledger specifications are built for exactly the transaction profile that tokenized institutional assets require. The institutions are not discussing this loudly. They are positioning quietly. That is what institutions do. They do not announce before they accumulate. They accumulate, then they announce. And when they announce, the retail crowd calls it a surprise. It is never a surprise. The data was always there. The filings were always public. The on-chain flows were always visible to anyone who knew where to look. The only thing that was missing was someone connecting the dots clearly enough for the informed investor to act before the crowd catches up. Let me give you the sequence, because the order of events is where the edge lives. We are currently in the accumulation phase. Exchange reserves at multi-year lows. On-chain data showing long-term holder behavior. Tokens moving off exchanges into cold storage at levels not seen since before the 2021 bull run. This is not retail accumulation. Retail does not have the capital to drain exchange reserves at this rate. This is the quiet positioning of entities that move before the headline. The next phase is the regulatory crystallization. The Digital Asset Clarity Act, currently in markup, will, if passed, permanently codify XRP's commodity classification under federal statute. When that classification moves from regulatory interpretation to federal law, the last compliance objection from the most conservative institutional allocators disappears. Pension funds, insurance companies, sovereign vehicles, every entity that was waiting for legal certainty, not regulatory opinion, actual law, gets its green light. The phase after that is the infrastructure announcement cycle. Hidden Road's full integration with XRP Ledger post-trade settlement is not yet complete. When Ripple announces operational go-live on that infrastructure, the $3 trillion annual transaction flow becomes a real-time data point rather than a projection. Analysts will model it, institutions will price it, the market will react to what was already contractually true. The window between where we are now and where the announcement cycle begins is the window that the informed investor has been given. That window does not stay open indefinitely. Infrastructure completes on a timeline, legislation moves on a timeline, and institutional positioning accelerates when both converge. Let me make the supply picture concrete so it lands the way it should. 100 billion total XRP fixed, no inflation, no additional issuance. 57 billion in circulation, exchange reserves at multi-year lows and declining. The tokens leaving exchanges are not going to retail wallets. The wallet size distribution on those outflows is institutional. Ripple's escrow releases 1 billion XRP per month. Historically, the vast majority of that released XRP is immediately relocked in new escrow tranches. The net new supply entering the liquid market from escrow is a small fraction of the headline number, and that fraction is being absorbed by the same infrastructure demand that is draining exchange reserves. Think about what happens to that supply picture when Hidden Road's $3 trillion annual flow is actively using XRP Ledger for settlement, when tokenized RWA platforms are using XRP Ledger for finality, when the BlackRock threshold is crossed and institutional ETF demand adds a third demand vector on top of infrastructure utility demand and long-term holder supply restriction. The supply is fixed. The demand vectors are multiplying. The timeline is not measured in years. The legislative calendar, the infrastructure integration timeline, and the ETF flow trajectory are all converging on the same 90-day window. This is what asymmetric opportunity looks like before it becomes consensus. After it becomes consensus, it looks like a chart you wish you had bought earlier. You are watching this before that moment. What you do with that timing is the only variable still in play. Let me make this concrete with numbers so the abstract becomes real. At current prices, $1,000 buys you approximately 450 XRP. At Standard Chartered's near-term target of $5.50, those tokens are worth $2,475. At $12.50, their cycle target, they're worth $5,625. At $20, the utility model output, assuming 5% Nostro-Vostro displacement and institutional ETF demand, they're worth $9,000. At $50, the scenario where prime brokerage integration, tokenization settlement demand, and institutional ETF flows converge simultaneously on constrained supply, they're worth $22,500. At $5,000 invested, multiply every number by 5. At $10,000 by 10. Maximum downside from current prices based on on-chain cost basis clustering is approximately 12 to 15%. Maximum upside in the convergence scenario is measured in multiples. That asymmetry does not require XRP to do something unprecedented. It requires XRP to do exactly what it was engineered to do, at the scale that the infrastructure Ripple just acquired now makes possible. Here's the only thing I want you to leave this video understanding. The Hidden Road acquisition was not a headline. It was a filing. The XRP Ledger integration was not a press release. It was a product roadmap. The legislative timeline is not a rumor. It is a public committee calendar. The difference between the investor who captures this move and the investor who reads about it afterward is not intelligence. It is attention. It is knowing where to look before the crowd looks there. Comment Ledger below if you made it to the end of this breakdown. It tells me you're one of the investors who actually does the work. Knowledge is the only hedge. Stay sharp, stay positioned. I'll see you in the next one.